Welcome to this edition of IG Live. We're taking you through to the non-farm payroll data out in 5 minutes' time, where we'll be trading the markets up to that point. I'll be with my guests for the next 10 minutes in just a couple of moments' time. It's Axel Rudolph, IG's chief technical analyst, for a look at the markets and how we trade this number, which is critical, bearing in mind the very strong numbers we saw out yesterday from ADP. It came a day later because of the holiday weekend. It was effectively a long weekend for many people, which took you through to Independence Day on Tuesday. So we got that delayed date for ADP, and it came through with a very strong number at 497,000. Let's take a look at what we got today and what the expectations are. Job creation is expected at 225,000. Now, bearing in mind yesterday we saw the ADP come through at 497,000. We had been looking for 228,000. Now, if you add that sort of incremental potential increase on that, we should, in theory, get something in excess of 500,000 jobs created for non-farm payrolls. Now, that would be right off the top of expectations of even the most hawkish of economists. We'll have to see how this number stacks up in 5 minutes' time. That unemployment rate is also of interest as well. It's been bubbling around this 3.6, 3.7% number for a while. In the previous month, it had been 3.7%. So that is expected to tick down a notch as well. Average hourly earnings at 4.2% year on year. It's not quite as high as that inflation number. And that's an inflation number which the Fed is really concerned about. And what it doesn't want to see is a creeping up of these average hourly earnings towards and possibly even at some point above that inflation number, because that then brings about this threat of a wage price spiral, which is going to be even more threatening to the future of the economy. And that will really put the foot right on the accelerator for the Fed. Already they've got their foot firmly on that, and it is expected we'll see two further increases in interest rates this year, possibly 25 basis points each at two more meetings so far this year. That's what's been priced into the market. Let's catch up now with Axel Rudolph with a look at this. And as I said, Axel, if we can look at this from a perspective as how we trade this number, bearing in mind we had that strong ADP number, and bearing in mind the Fed is just waiting for, I think, possibly an excuse to pull the trigger again for another 25 basis point increase. I think the meeting in about 2 weeks' time. And it's widely expected we'll see another interest rate rise come through sooner, possibly rather than later. How are you feeling as a technical analyst in terms of the charts going into this number in a couple of minutes' time?
Well, what looks pretty interesting to me at the moment, Jerry, is that the euro-dollar daily financial bet here that I've got up on this chart, it's currently testing the downtrend going back to June. So we'll have to see whether, if the number does disappoint, which is pretty unlikely to be honest, then the US dollar would sell off and euro dollar would be rising and break through this downtrend line. In which case we could perhaps head back up towards the 110 area where we topped out back in June. So that'll be interesting to see whether that's the case or not. I mean, let's not forget that I think over the last 12 months, the non-farm payrolls number came in stronger than expected 11 times out of 12. So it's pretty likely that this time around it's going to happen again. And the surprise would really be if the opposite is the case, if we have a lower number than the 225 you're just alluding to, in which case, as I said, euro dollar could rise. So that's a possible way to play the actual number and see whether we see some upside in euro dollar again.
You're ever the statistical analyst, aren't you? I mean, looking at these numbers, you're saying it's beaten 11 times out of 12. Let's say we get another beat. How is this going to lay out across the equity markets? Which indices are you looking at particularly when looking at this number? And if we do get that excess on the upside coming through, how is that likely to play out on indices?
Well, we saw the impact yesterday already of this much stronger than expected ADP job number at 497,000, as you said, much better than the 228,000, which were expected. And that really led to a very sharp sell-off in European equity markets and also in the US. And in the US ones, you can see here on the S&P 500, we basically had to redraw a previous uptrend line we had in place. And we're holding above that today. But if we see another strong reading with the non-farm payrolls number, then that would be the fourth consecutive stronger than expected reading since March of this year. And it would probably lead to further downside being seen in the S&P 500, which would then take us not just through this uptrend line, but also through yesterday's low, which is around 4,384. And then basically it's quite possible that we could actually sell off to the late June low around 4,328. And that's the key line in the sand for me, technically speaking, with regards to the trend.
Okay, right, we've got the numbers. Let's take a look at the minute-by-minute chart on my IG platform here with the euro-dollar trade, and you can see clearly the euro is up. And that would indicate that we've got a number which is slightly weaker, which is exactly what we've got, 209,000. Now, we've been expecting something like around about 225,000 jobs having been created. The unemployment rate is at 3.6%. The average hourly earnings have come in pretty much in line with expectations. In fact, if anything, the year-on-year figure is 4.4%, which is just a tick or two higher than expected. But I'm interested in this number. It is coming weaker than expected. Now, I'll get back to Axel in just a moment, but I do want to dwell on this chart here that we've got. And you can see that we're seeing traders buy the euro-dollar trade. It is only a minute-by-minute chart. When you look at minute-by-minute, it quite often looks an extreme move. But if we go back to what is the longer-term pattern here, and you can see that Axel was talking about this uptick that we got for a second day in a row. And this is just marching a little bit ahead from where we are. We're now over the 109 level. For the euro-dollar trade. Just want to pick up on some of this data again and take a look in some more detail about what we've got. As I said, non-farm payrolls coming through at 209,000. I don't have any adjustment to the previous number at 306. But as I said, that is slightly weaker than the 225 we had been expecting. More often than not, there has been this correlation between ADP and the non-farm payroll figure. Certainly when we get a very strong ADP in the past, we've definitely got a very strong non-farm payrolls coming through. But this time around, it's not happened. And we've got that slightly weaker than expected number. Just to quickly look at some of the other numbers, government payrolls are stronger than expected. Average weekly hours is coming through absolutely in line with expectations, and the participation rate has not changed at 62.6%. So we've got this non-farm payroll figures coming in slightly weaker than had been expected. I just want to take a quick look as well at what's happening with the tech market. This is the NASDAQ. I mean, Axel was talking there about what's been happening with the S&P 500, but you can see there's a little bit of a relief rally going on here, because what it does, I think, for me, and Axel, perhaps maybe I'll bring you into this discussion, because what this says to me is that the Fed's getting maybe a little bit more room, I think, more than anything else, rather than race into another interest rate rise. It may well see another 25 basis point at the next rate meeting, which I think is priced into the market. I haven't seen any changes in that since we've had this data out today. But for me, this number looks like it gives the Fed a little bit more room rather than has to see the Fed charge him with another interest rate rise and questions about whether it's going to be 50 basis points or 25. This is a weaker number than expected, and I think this is as I say, gives the Fed more room. What are your thoughts?
I totally agree with you, Jerry. I mean, yes, it does. We will probably still see a 25 basis point rate hike at the next meeting. I mean, yesterday, the probability of that happening, according to the CME FedWatch tool, went up to 90%. It'll be interesting to see now how that has dropped off a bit. And that compares actually to 50% just a month ago. So it may give the Fed a little bit more wiggle room. Maybe we'll see what we saw in June, where we have a pause after the next rate hike at the next month meeting. And we'll see what happens then. But interestingly enough, what I just looked at is the gold price. If you look at the daily chart of gold, now gold yesterday, despite equity markets coming off quite sharply, didn't really see the flight to quality flows that we normally see in such a situation. And today actually is rising in line with the S&P 500 and the NASDAQ that you just alluded to. So here what is interesting is that we are again retesting this resistance line, which comes in from the high seen back in May. And we would have to rise above there, sort of $1,928 per troy ounce. And then this week's high at $1,935 per troy ounce for a bottom to be formed. So right now we're pushing against that upward resistance on that weaker reading in the non-farm payrolls number.
Yeah, I'm just looking through, as I say, it's, the data that we've got. Just as an aside to this, we've also seen some numbers out from Canada. I'm not going to ask you about this, Axel, because I'm just going to say very briefly, we've seen some Canadian data out as well on the jobs data, and the employment change there has been a little bit stronger than expected. We've got the Bank of Canada out next week. As I say, it's just some more data that's coming through. I'm not going to go into what's happening on the Canadian dollar or anything, but I think it's just worth looking at the fact that North America is continuing to see some nice heat generated. But for me, Axel, I think the question is whether we're going to get a soft landing. This is a long-term question, and it's not necessarily about what we're going to see from the Fed now, but I guess many hoping for some sort of soft landing. And it's a question of whether or not the Fed's done enough to quell inflation, whether inflation is still going to hang around. And indeed, if they do keep on raising interest rates, the big question is does the US then go into recession? I don't know if you've got a view on this. I know you're a technical analyst rather than a fundamental analyst, but I know you look at the wider picture and have to consider all aspects of an economy. But when you get numbers like this, the hopes have to be raised that a soft landing is going to come through.
Yes and no. I mean, basically, we had one single data set today. And as I said before, since March, actually all the non-farm payrolls readings actually surprised to the upside. Now we've seen a surprise to the downside. What the Fed will probably want to see is another weaker number at the next month non-farm payrolls data release. And then we could perhaps see a trend of this sort of peak having happened since March to July, and then from July onwards coming off again, which would then indicate that the labor market in the US is not perhaps as strong as we seem to have thought just yesterday, for example, when we had this really, really strong ADP employment reading. But I wouldn't read too much into that data that we got out just today, because there could be revisions going forward. We've seen that in the past. And if the revisions are to the upside once more, then perhaps the Fed is still struggling with the tight labor market, and therefore wage inflation also putting pressure on inflation in general, and core inflation remaining pretty high in the US and not slipping towards the 2% target that the Fed is aiming for.
Yeah. Axel, just quickly before we leave you, you started off on the dollar trade. Let's take a look at that euro-dollar chart again. I'm just looking at my chart, and I'm seeing that there are very few sellers, if any sellers at the moment on euro-dollar. 109.30, we're right at the top of the candle. If we can bring up Axel's euro-dollar chart, if you could just talk us through this and just explain the trade to follow on from this data out.
Well, basically what we're seeing here is a break of that downtrend line that has been in place since last month. And once this has happened, we're going towards the last reaction highs and lows. So the next upside target, very short term now, is probably going to be tested in the next few minutes. And that's around 109.34. That's the early July high here. And then the technically more significant level is the 27th of July high, simply because this is a last reaction high. That is to say, a high on this candle was higher than the one on the left and to the right of that candle. And this is the 27th of July high at 109.76. So that would be my next technical upside target, and then followed by the June high at 110.12. And above there, you can also see here a really, really good resistance area made up of the mid-April to late April highs between 110.75 and 95. But basically, from a technical perspective, provided we keep holding above these lows we saw over the last couple of weeks, going down to 108.35, provided we don't fall through there, basically what we're seeing is a short-term break of a downtrend line, which is bullish, and it looks as if we could be heading back up again towards the 110 area.
Yeah, interesting. Okay, Axel, thanks so much indeed for joining us. That's Axel Rudolph with his views on the market, on from that number coming through for non-farm payrolls, coming in weaker than expected at 209,000 for the month of June. We have been looking for 225,000. The effect of this has been the long trade on euro-dollar succeeding, and as Axel was saying, breaking through that short-term resistance, downward resistance that we'd got, and looking at potentially a slightly stronger start, especially for tech stocks. Interestingly enough, the Dow hasn't performed as strong as the Nasdaq, but I think if any evidence is needed, and if any evidence does come through to suggest that perhaps maybe the Fed has got more room, I think this is only ever going to be good for some of these tech stocks. Don't forget, next week, of course, is the real start of the second quarter earnings season in the States, and it'll be really interesting to see what corporates are saying. If we get anything like we got yesterday late in the session from Levi Strauss, where we saw the post-market trade down 6%. The concerns were very much about the outlook and the fact the company wasn't able to give any encouraging thoughts about where earnings were going to go. And it's because of that that we've got this drop in the stock of Levi Strauss at the start today, when we get the numbers coming through in terms of market representation of the data out that we saw from Levi on its second quarter out last night. But next week we've got JP Morgan Chase, we've got Citigroup, we've got United Health, we've got Delta Airlines, all trading all session stock on the IG platform, and that's next Friday, and that could well be the next interesting bit of data to watch out for as we consider what's going on in the minds of those voting on the Federal Reserve. My thanks once again to Axel Rudolph. You can catch up with more with Axel if you go to his Twitter feed or indeed on the IG platform. Just dial in his name and you can see some of the reports that he pumps out there on his technical analysis of these markets. We're back at 4 o'clock this afternoon on the IG platform with a look ahead to next week's trade.